when I get my money back, let's say dollars, let's say in a year's time, what's it going to buy? What's it going to be worth? What's the purchasing power of that money which I've committed to a bond or whatever? What's that going to be worth? So you can see that these three elements are likely to rise quite considerably as credit risk begins to dominate our thinking. And under those circumstances, I think the forward thinking that an investment manager does has got to sort of, if you like, just encompass those very, very facts. So I think that's what I would say in the current situation.
From precious metal standpoint, and I can speak to the larger economy after, but you can't keep suppressing a market when the world is pushing back against you. The only way to do so is to push it in the direction that it is going. And as I've said on your show for 5 years now, that the biggest money in the world is wise to suppressing. When you see 8 Western banks holding the largest concentrated short position on 1,000 commodities traded on the COMEX, and that being in silver for years in a row, it's not too hard to see it if you look.
I'll try and put it in a context which makes sense for investment managers. We are in a credit bubble. There is no doubt that bank credit has been expanded in favor of financial assets. And more than anything else, this is really what drives equity markets in particular. And we've seen this. We've seen this really over the last 2 years with the S&P rising from 4,000 or less or whatever. Currently, we're looking at 6,900, thereabouts. I never follow it that closely, but we're talking about a substantial rise. And the background to this has been a gentle drift in bond yields. They peaked, if you look at the 10-year, it peaked at around just a bit under 5%, I think, a couple of years ago. It's gone back and up and down. And currently it's around about 4%. So that has been a fairly benign background against which there has been a substantial increase in the amount of credit aimed at assets. And if you look at the level of margin finance, which is a statistic that FINRA runs, margin finance is running at an all-time high. we're looking at $1.12 trillion. Bearing in mind that 10 years ago, we were looking at about $250, $300 billion. We're now, we're now well over $1 trillion. Now, the point is that finances positions probably about 3 times that. So there is a substantial amount of froth in these markets. So we have an equity bubble.
When credit is flowing into assets, markets can become frothy. Historically, bubbles form when credit growth aligns with speculative buying rather than investment grounded in fundamentals. Think of the late 1920s. Equity markets soared, vast wealth was created in financial centers, second homes and luxury spending followed, while Main Street lagged. Today we see similar signs, margin debt at record levels. The customers' debit balances in margin accounts hit $1.2 trillion in September. The risk, when the music stops, the end is often sudden and painful, especially for those heavily exposed.
So far, this is rather like the Roaring '20s, 1926 to 29, when everything was tickety-boo. Everybody in Wall Street was extremely happy. People in Main Street weren't doing terribly well. They were holding body and soul together, but not an awful lot more. But, the real happiness was really in major city conurbations, where all the wealth was being created in markets, and it was sort of spreading out into the restaurants, into second homes, into fancy holidays and all the rest of it. And that's where we are today. The problem with these bubbles is that they do come to an end. And when they come to an end, it can be really quite sudden and quite violent. And I think for an investment manager, that's the first thing he's really got to understand. He may be a very clever fund manager and made an awful lot of money for his clients by, sort of playing the momentum stocks and Bitcoin or whatever. But just bear in mind, the whole thing is driven by credit expansion aimed at puffing up assets. And that basically is what's been happening. That comes to an end. And if you're left holding the baby when it ends, you are going to lose an awful lot of money. So I think that's the first thing that you've got to plan for. When it pops, then there is going to be a huge second problem, because when it pops, you're going to get a market that goes down considerably. I'm talking about equities here. You will see an increased amount of risk in bond markets, which basically means their yields will rise at the same time. Now, this is an awful combination, but this is what happens. This is what happens when a bubble pops.
Every credit-fueled surge eventually runs out of runway. When it ends, the consequences are typically severe. Equities fall sharply, bonds suffer as yields rise, and leveraged positions unwind. Margin debt amplifies the damage. When collateral values drop, margin calls trigger forced selling that accelerates the decline. Rising yields also threaten debt-heavy companies, those so-called zombie firms that took advantage of ultra-low rates. When financing conditions tighten, both public and private debt burdens become more onerous, and government deficits start to bite.
And consequently, you find that all that margin debt, it gets foreclosed, and you get a situation where people who have portfolios which they're using to secure other finance, they get sold out because it no longer covers the bank's liabilities. You've got other problems that come from the increased risk being reflected in higher bond yields. You've got all the zombie companies in the economy who took out all that debt, particularly when interest rates were at the zero bound, and in other countries at negative interest rates. They're in the business now of having to refinance that. I mean, we're looking 5 years on. So this is not good. And as far as government is concerned, they've got huge debts, which are going to prove to be even more difficult to finance in the event of rising bond yields. So how do they handle all this? They're going to have suddenly all these obligations coming through, because apart from anything else, their welfare obligations are going to go up. And at the same time, their tax income is going to go down. So they're going to have larger budget deficits. So, this is going to be very, very difficult. So that's the second, if you like, element, which I think you've really got to start thinking through. In terms of investment strategy, I would look to sort of start easing my way out of the momentum stocks. They may go further. You're never going to hit the exact top. But I would look to lessen my exposure to those. And the other thing I would then do, and maybe not immediately, because I think as the bubble pops, you're going to get a substantial amount of selling across the board. And anything where people have got profits, they're going to be just realizing them and running the losses. I mean, that's the way it works.
For the professional investor, the key is recognizing the stage of the cycle and adjusting accordingly. Momentum stocks may still run further, but exposure should be trimmed before the reversal gains traction. What to consider? Rotate out of highly leveraged equity plays and begin positioning toward real assets. In particular, now may be the time to look at commodities, including base metals, agriculture, and precious metals, as inflation and supply shock risks mount. Shifting ahead of the pivot can make the difference between being caught flat-footed and being value-added.
So there is going to come a time, I think, when you're going to sort of start thinking, right, we've got to invest in mining stocks. And I'm not just talking about gold and silver, but base metals in particular. Agricultural products, perhaps, because I think these prices are going to rise. They're going to rise very, very substantially. That's going to be the new place to go. And good technical analysts are already seeing this beginning to develop in the wider commodity sphere. So I think that's your game plan. The timing obviously is up to the individual investment manager, and I wish him jolly good luck. So to summarize, I think the first thing is you've got ahead of us, we've got a credit bubble popping. But realize that when it happens, this sort of neo-Keynesian idea that, the Fed can control interest rates and bring down interest rates and bring down bond yields. No, that's rubbish. That's not going to happen, because what will happen is that bond yields will start reflecting the risk in credit. Not risk, but just add the three elements of this risk. If you go and buy a bond, you're losing possession of the money, if you like. It's going into the bond, so you can't use it for something else. So there's an element of interest payment to cover that. You've also got individual borrower risk. So that is another thing that you take into account. And increasingly now, there is another factor. And that is, when I get my money back, let's say dollars, let's say in a year's time, what's it going to buy? What's it going to be worth? What's the purchasing power of that money which I've committed to a bond or whatever? What's that going to be worth? So you can see that these three elements are likely to rise quite considerably as credit risk begins to dominate our thinking. And under those circumstances, I think the forward thinking that an investment manager does has got to sort of, if you like, just encompass those very, very facts. So I think that's what I would say in the current situation.
From precious metals standpoint, and I can speak to the larger economy after, but you can't keep suppressing a market when the world is pushing back against you. The only way to do so is to push it in the direction that it is going. And as I've said on your show for 5 years now, that the biggest money in the world is wise to suppressing. When you see 8 Western banks holding the largest concentrated short position on 1,000 commodities traded on the COMEX, and that being in silver for years in a row, it's not too hard to see it if you look.
Turning to the real asset side, precious metals and industrial commodities are receiving greater attention. On the gold-silver front, rising real yields and supply constraints are drawing institutional interest. Some large banks and sovereigns are taking delivery positions rather than just paper exposure. Meanwhile, base metals and agriculture are being repriced in light of infrastructure and decarbonization themes. Given rising inflationary pressures, devaluing currencies, and elevated credit risk, hard assets offer a hedge and diversifier that paper assets no longer reliably provide. The smartest money is signaling this real asset move.
That it is certainly a collusion of the West for reasons. And you could argue gold for Gibson's paradox, the inverse relationship between real interest rates and the price of gold. And I would argue silver for the military-industrial complex, the need to make high-tech weapons, the need for massive amounts of silver to do so. And we've talked about that ad nauseum. I don't need to go into that, but the world is wise to us. And this is why you see coordination between countries that are sophisticated and motivated and wealthy now and understand what we're doing and using it against us by standing for delivery. In fact, probably shorting it themselves to do so. That's why China, the largest producer of gold and second largest producer of silver in the world, are actually taking the time to fly to Latin America to buy gold and silver directly from the miners, like Sean Kun, Dolly Varden, who told me this, and paying double what the West will, and sending it back for refining when they're already producing more than anyone in the world. Why would they do that if it means nothing? They see the big picture. That will end. And in terms of the way that this sequence goes on the bigger picture, we're seeing inflation spiking, I think. I mean, they're giving up to it. It's at 3%. It's much higher, which we said it's 11, really, if you ask John Williams. And they're going to pour more gasoline on the fire right now, even though they're 50% away from their target. To Alasdair's point, this would lead to bond losses. To Alasdair's point, again, this would lead to central banks panicking, doing yield curve control, suppressing interest rates, which leads to currency declines. And if the currency is declining already in a period of time where no one trusts the institutions and the markets really anymore, because we have weaponized the treasury against countries like Iran and Russia, yet we've been in Iraq for 22 years. under false pretenses, destroyed their country, toppled their regime, and we're still there occupying their country. How is that fair? Now, I'm not making any judgment on Iraq or on the Ukraine or Russia war, but how is it that we can tell Russia, well, you know what, we're going to take your treasuries that you have stored with us? And
in the current environment, assumptions that bonds are risk-free, currencies stable, and interest rates controllable must be re-examined. Credit risk is rising, inflation is creeping higher, and monetary authorities may not have infinite control. For example, margin debt relative to GDP has climbed to around 3.7%. Governments with high debt loads face refinancing risk if yields rise, a major strategic tail risk for portfolios concentrated in financial assets. A prudent investment policy should assume that inflation, currency debasement, and asset price deflation are real scenarios. Real assets, hedging strategies, and careful credit overlays are no longer optional. They are essential.
We're going to confiscate, in essence, default on them, and we're going to give it to largely in the form of weapons to the Ukraine. And that's okay, but we go into Iraq for faulty reasons, and we're still there 22 years later, and we've just decimated the country. So when you talk about trust, there is none any longer. We are not trusted. That's why U.S. Treasury holdings are down to their lowest level ever, like 39% across the board. And so as it goes from inflation to bond losses, to the panic of yield curve control or suppression of interest rates, to your currency declining, along with no trust, you get a flight to hard assets. And isn't that what we're seeing right now with the acquiescence of the big commercial banks to tell their institutional clients, you better get 20% of your assets in gold now? And I think people and institutions need to front run that sequence, period. And it's really not hard to see that. I think for me, my assumption that I make is that you build a policy assuming inflation and currency risk is real. And we've lived, this is a problem, all of us in the West have lived in a world where bonds were risk-free. They're not. And that currency was permanent. It's not, right? My father, first year out of college, married my mother, and $6,000 a year starting salary at Helene Curtis Cosmetic Company way back when was enough for him and my mom to live comfortably on $500 a month, comfortably, in 1963. And I said, there's no way, Dad. Yeah, look it up. The average salary was 10 grand that year, 9 or 10 grand. So out of college, first job, okay. All of this stuff is not permanent. And this was during a time when the United States and London, UK, were revered, were thought of as the bastions of honesty and integrity and free market enterprise, and they're not. And now we have policy that is coming in that is frightening the world through sanctions and tariffs masquerading as tariffs that are actually sanctions, and fiscal irresponsibility to the nth degree, where we create $1 trillion of debt in 71 days, right? Trillion sections ago was 31,688 years ago. We can create $1 trillion of debt in 71 days. And we bring on a company or a group like Doge, who finds $2 trillion in things that could be cut, but Congress can't agree to more than $200 billion. That's about 38 hours of spending by the U.S. government. So if you assume that inflation and currency debasement, what are they calling it right now? The debasement trade. Oh, really? They're just getting on that? So if you assume that currency and inflation risk are real, and that bonds are not risk-free, and that the dollars you hold are not permanent, in fact, they act more like a melting ice cube, then you'll be better off and understand the reasons to hold gold and silver, not to become wealthy. You might if you own enough, but because it is wealth, that the smartest money in the world is telling you through their actions they agree. The most well-informed money in the world is telling you they agree. Take it for what it is. Don't take my advice. Look at what the big money is doing, and you'll see that they're leaving the equity markets and they're moving to tangible commodities in their own possession. And that is the truth.